All right. Okay. Well, I just want to thank you, Bill, for being here again. And go ahead and introduce yourself. I've known Bill now for several years. Bill, real quick off the bat, is a seasoned investor and also a tax expert. So he's a very unique individual in that he knows the insides and outs about the tax strategy that goes along with specifically creative finance investing, and that combination is very unique and probably difficult to find. And so it's awesome that Bill is able to join us today. So thanks for being here, Bill. And why don't you just introduce yourself briefly for the viewers?
Sure. Okay, thanks. Thanks for having me, Hans. Yeah, I like to consider myself a reformed CPA. My background is in accounting and finance. I have a graduate degree in a master's degree in tax law. I started out with an accounting practice years and years ago, and most of my clients, for some reason, ended up being real estate investors or realtors. Okay, imagine that. And I quickly noticed that profits were higher on the other side of the table. So I sold my practice out and became a full-time real estate investor, thinking I would not be doing anything with tax again, right? But my clients kept saying, "What are you doing? We need you," right? So I ended up focusing on tax strategy. So I don't prepare the tax returns anymore. I work with my clients' accountants with their taxes, and I just focus on creative deal structure and tax strategy that goes along with that deal structure. I have been able to marry my two favorite possessions, tax and real estate investing. So it's, a win-win situation for me, and I hope for my clients as well.
Why would somebody want a tax strategist if they're doing subject to deals or any kind of leasing options, contract for deed?
Well, what's interesting is every real estate deal has a tax outcome, right? It's going to affect your taxes. Let's face it, taxes affect everything that we do, right? And that affects us as real estate investors as well. And if you choose the wrong strategy, if you choose the wrong entity, it can affect you immensely tax-wise. For instance, if Internal Revenue Service classifies you as a dealer, right, they consider your property to be inventory. And any deal that you make, any deal that you close is going to be considered a dealer deal, right? Flipping, wholesaling, anything like that. And that's taxed not only at ordinary income tax rates, but it's also got a 15.3% self-employment tax that comes along with that. So if you close a deal for $100,000 and that's your net profit and you're classified as a dealer, right off the bat, you owe $15,300 and you've not even paid the ordinary income tax yet, right?
Yeah.
Whereas if you're classified as an investor, which is how I help my clients structure their deals, make them investing deals and not dealer deals, right? The only thing you pay is capital gains, right? So if the capital gain is long-term, you pay long-term capital gains rates. If it is short-term, you pay short-term capital gains rates, which is just your ordinary income tax rate. So you can save thousands of dollars by structuring your deals correctly.
Yeah, that's pretty massive. So that would have implications. So talking with somebody like yourself and getting clear about what the nature of your business is, whether you are a dealer or an investor, and
Right.
have that influence your decisions on the exit strategies you choose.
Sure. And one thing that's important also is that you do this consulting before the fact, right? Not after the fact, because after the fact, it's a bit late. There's not a whole lot you can do with it. So if you want to make sure that you're structuring everything correctly, you're going to want to do it from the get-go. And if your tax person is not sitting down with you at least once a quarter, maybe every other quarter, if you're not a real active investor, then you're getting screwed tax-wise, as far as I'm concerned, because there are certain things that you need to do before year end to make sure that you're covered tax-wise.
Yeah, and this has implications for folks doing probably like wholesaling and doing some investments, or maybe they're just doing wholesaling and they are considering holding a property or two, but like, or this also has implications for people doing contract for deed and or lease and options. Like, so all of the above, right?
All of the above. Every type of deal has a tax outcome. And a lot of times what we end up doing is focusing maybe on the legal side, the liability side, because I have clients all the time who are worried about what type of entity they have. Do I need an LLC? Should it be taxed as sole proprietorship? Should it be taxed as a partnership? How should it be taxed? And how should it be set up for liability purposes? But they don't always consider the tax implications, right? And I said, how should it be taxed? But what they're really doing is looking for entity protection. For instance, do I need one property per LLC? Or can I have a holding company that owns all of these little baby LLCs? That's what they consider most, and that's the entity structure itself and the liability part of it, but they're not always looking at the tax implications of that choice.
No, totally. It's like the last thing that we think about when we're getting into this
Of
business,
course,
just trying to get our
right?
feet under the ground. And then
Well,
we start to do a couple deals or here and there, and then we meet with our CPA and quickly realize, oh, there's some tax implications.
we have tax, right? And the that's not a bad thing necessarily. As investors, and I am one, right? We tend to think of the deal. We don't always consider the tax implications. That's not most for me. Okay, that was an exception because I am a tax guy, so I look at everything from that perspective, right? But most investors don't. That's not uh, their lane, right? That's not where they focus. And I don't think that investors should expect to be tax experts. That's not the point. That's not the best use of your time, obviously, right? But I think investors need to be educated enough to know what questions to ask. What should I ask of my accountant? What should I be expecting? And speaking of asking questions, one thing that you do not do when you talk to your tax pro is say, can I deduct that? Right? Because 9 times out of 10, the gut instinct is, oh, no, you can't. Right? So a better question is, how can I deduct that? Which forces the accountant to sit back and say, okay, let's see if there's a way we can do that. For instance, you ask your accountant, say, hey, can I write off my dog's food? Right? Oh, no, that's not deductible. That's a personal expense. Okay? And most of the time that's correct. But what if your dog happens to be used as security? Okay, that makes those expenses a deductible expense. What if your dog, wears a sign like my Bailey boy did that says "My daddy buys houses" and is used in all your advertising, right? That
Right.
makes it a deductible expense. Somebody says, "Well, that's kind of strange. You allowed to write off your dog expenses." Well, tell that to the Clydesdale horse owners, right? Do you think they don't deduct those expenses? And all that is advertising for Budweiser,
Hmm.
right?
Fascinating. Yeah,
So
yeah.
you just kind of have to take a look at it and ask yourself, how can I make this an expense for my business, right? Remember, expenses under Code Section 162, right? That defines expenses. It's got to be ordinary, necessary. Okay. Advertising is ordinary and necessary when you're marketing for deals, right?
Right.
So you just got to consider what types of things can you write off.
Yeah, no, that's huge. Once you start to actually start doing some deals and you start to feel some tax consequences, it's pretty crucial. I think it's kind of it'll be anybody's gut instinct. Anybody watching this who's maybe done a couple deals, met with their CPA, they're going to know exactly what we're talking about. And if they're not at that point yet, well then you're right. Like, just focus on getting the deal first. Like, focus on getting your feet underneath you. Get a deal or two, but then you're probably going to be like, I need to wise up and get with somebody who's going to be able to really kind of help me with these things. So, let's go to since you are a seasoned investor, let's kind of go through your preferred strategies.
Sure.
Focus on the creative side of things
Okay.
here for acquisition and disposition,
Okay.
and why you prefer that, and maybe with like a focus on the tax implication.
Absolutely. All right. So I have a hierarchy that I enjoy. In instance, I begin all my deals at a certain level, and then I'll work my way down until I find one that works for that particular deal. My go-to, as most investors would be, is Subto, right? If I can get a property subject to, I am all over it in a heartbeat, right? And of course, that is taking the property subject to the underlying loan, right? And most of the time, we get the deed, or preferably our trust takes the deed. All right, I always prefer that. And we control the property, and all we do is make the payments. The loan does not go in our name, right? Now, the tax implications of that: you own the property, it is yours. Okay, therefore, you get all of the tax benefits of owning that particular property. That includes if you are an investor like we are. If we're going to hold, let's say we're going to take the property, we're going to hold it as a rental, right? We get depreciation expense. We get to write off the mortgage interest that we're paying as we make that loan payment. We get to take repairs, maintenance, whatever. It's our property for all intents and purposes, right? And our exit strategy, may be to hold it. It may be to sell it. We can do whatever we want with that particular property. Okay?
But can I interject and
Absolutely.
just to clarify, because this is a question that I see often about just to clarify what you just said there. So when you buy subject to, you are getting the deed and they're owning the property. And you get to, so if the seller comes to you and says, what do I do with my taxes? And I had this happen a couple times in 2023. Earlier this year, a couple sellers from whom we bought sub 2, they were asking me, like, hey, what should I do for my taxes with this property that I sold to you, but I left the loan in place? And I told them basically what, and you can reiterate this, can confirm that this is correct or that I was wrong, but essentially that, you can take that interest and property taxes up to the date of the sale. Like, you can write that off, but then at the date of the sale, moving forward, it's ours. We get to write off the property tax expense and the mortgage interest expense.
Correct. That's absolutely right.
Okay.
And what sellers sometimes forget is they sold that property. They've got to report that as a sale on their tax return. Okay. Now,
Correct.
most of the time, investors, if your seller is an investor, they kind of understand that, right? They know that they've sold the property. They want to take the sale on their tax return. But if someone is maybe living in the home, it's their personal residence right now, and they sign it over to you sub 2, whatever the reason may be, they don't always remember that, hey, I've got to report that as a sale on my tax return.
Mm.
Okay?
Mm-hmm.
So they do have an investment. Now, of course, you've got to consider the circumstances, right? If you are taking over a property subject to and it's in foreclosure, okay, they're not making any money on that. Even though it's still a sale, they're not going to be making a gain or loss. But let's say that you take over a property that has equity in it, right?
Mm-hmm.
Their cost basis, remember, the equity amount is not always their gain on the sale. Some people think that, oh, I have a loan on the property and I'm giving it to you for the loan amount, so I didn't make a gain or loss. That's not true. Okay. Because if they refinance, the loan on that property may exceed their cost basis. You don't know those circumstances. So you need to kind of remind them that, hey, you sold me the property and you need to talk to your tax person as to what you need to do as far as reporting this as a sale is concerned.
Right. And since, most of the properties are probably going to be owner occupied, where if there is a gain, it's less than, is it like 250 or whatever it is if you're a single person?
Yeah, they would have their gain exclusion, right? And so 9 times out of 10, they're not going to owe any tax, even though it still has to be reported as a sale. Anytime that deed transfers,
Oh.
they've got a sale situation. Whether they're getting cash up front or not, it needs to be addressed.
Oh,
And a lot of times we don't let them know that because let's say that you do have a $250,000 exclusion, 500,000 if it's joint, right?
okay.
So they may not pay taxes, but yet it still has to be reported as a sale on their
So
tax return.
the sub two seller, like regardless of whether they have any taxes to be paid on the gain, like if they got any cash out of the sale, right? They still have to report that on their tax return, regardless.
Because you don't know whether you've got the gain yet or not. Now,
Yeah.
you should be talking to, or they should be talking to their tax pro, because there could be a situation where because of other tax implications, they may not end up having to file, right? Because there's situations if your net taxable income comes below a certain dollar amount, right? Then you're not going to have to file anyway. But you won't know until somebody sits down and calculates that for you.
Okay. Yeah, that's interesting. I did not know that. I mean, and I'm sure that people get that question too, like, do I report this as a sale or whatever? But yeah, no, that's really good. That's good. So okay, so that's purchasing subject to. Like that's a common tax question on subject to. You like buying sub to because of all the obvious reasons that we all love buying sub to. Was there anything else you wanted to say about that before going to the next one down the line?
No, that's pretty much it. Just remember that you get all the tax benefits depending on the reason that you purchased. And one of the big questions comes up as to who gets to report the interest, and you alluded to that. One thing to remember: if you are making that loan payment, you're reimbursing that seller for the interest, and that's how sometimes I explain it to them, because they say, "Well, I've got the 1098 and it's in my name, and do I get to take the mortgage interest?" And you say, "No, you can't, because you sold me the property. And look at it this way, I'm reimbursing you for that interest, right? I'm paying you and you're making the payment, or I'm making the payment for you. So it's kind of a wash. Okay. I'm paying this in your stead. So you're kind of getting reimbursed for the interest payment if they're making the payment." So when I explain it as a reimbursement, sometimes it becomes a little clearer to them as to why they don't get to deduct it.
So I take it you've had some subject to sellers like challenge you on that in the past. Sounds
Oh
like
yeah, man, I've been doing this 40 years. You always have somebody who asks it at some point in time.
like they said, "Hey, I'm taking this. You can't take this. The loan's in my name, even though you've been making."
I don't feel like they come as much from the standpoint of I'm taking this and you can't. It's more of who gets to take it. Why can't I take it?
Okay.
Right. So you have to kind of explain to them why they can't.
Yeah.
Right. Even though it's coming in their name.
Right. Yeah. I think most subject to sellers are probably just happy to be done with the property. They probably never think about it again. But
Most probably
occasionally,
you don't think about it. And depending on your strategy for investment, like I like to go for foreclosures, right? Pre-foreclosures, like most investors, because they're some of the easiest to do. A lot of times those sellers are not even in the property anymore. They've already left the property. And it's like, okay, I had one where I said, "Hey, look, you're losing this property foreclosure. Why lose the property? I'll give you $500 to sign the deed over to me." Okay, I'm going as they're going out the door type thing.
hey, on that topic, you like to target houses going into foreclosure, pre-foreclosures.
Mhm.
How do you like to find those sellers? They can be really difficult to find sometimes.
Yeah, sometimes they are. There is a site called sheriffssale.net. And I can't remember if it's plural sheriffs or if it's sheriff. All right. But that actually, it covers the United States. You can pick a location and it will report all of the properties that are going into foreclosure or pre-foreclosure that have gotten demand notices and stuff like that. I found that to be the most reliable. I don't like to buy lists of foreclosures, honestly, because by the time you get them, something's already happened with the property. Okay.
Yeah.
The other thing that I have done is hired people to run down to the courthouse and look at the postings on the wall. Because remember that in most states, those liens and notices of foreclosure, notices of default have to be posted for a certain number of days. And they have to be posted publicly, and most of the time they're posted in the courthouse. I know in some of the counties I am in, you go in and there's a big bulletin board right as you're walking into the clerk of court's office, and they're all right there. You just go and flip through the postings and find out what they are. So if you want to do some legwork, you can do that on occasion. There, and it depends too if you're in a judicial state or a non-judicial state, right? Judicial means that the mortgage can be foreclosed on, but you have to bring a court action in order to get that done. In other words, you have to file and take them to court. That's usually a state that posts what we call lis pendens, which means, you know, notice of foreclosure type thing, right? And if you are in a non-judicial state, all they have to do is come in and say, hey, we're foreclosing, right? We're going to take you to court. We're foreclosing on this property. And in some states, it's less than 21 days.
Yeah. And are you primarily operating in your own local market for when you buy these properties, or do you buy outside
I consider my market to be the eastern part of the United States, right? Principally, really? I am in 5 usual states, right? I usually deal with North Carolina, South Carolina, Virginia, Kentucky, Georgia, and Tennessee.
Oh, really? So you're that spread across that region there. Okay. Yeah. Is there a reason why you are spread across and not just in your local backyard? And I'm just asking.
When I started doing master lease and option deals, that was my market area. Living in the mountains of Tennessee, I'm in a very, very unique situation, especially being up in the mountains where I am. I can leave my house and be in Bristol, Virginia in less than 30 minutes. I can be in Asheville, North Carolina in probably 45 minutes to an hour. So I'm in that type of location. And when I started to decide my target market, I thought, okay, I am going to draw a circle from where I am in, the mountains of Tennessee, and I'm going to do it a radius of miles that would allow me to be in that particular area in a 5.5 to 6 hour drive. Because I said, hey, 5.5, 6 hours, I can leave in the morning, be back at night. That type of thing. Literally, that is how I chose my target market. Okay. And it ended up including those areas. And it's interesting, that area includes Atlanta, Georgia, includes Nashville, Tennessee. It includes Richmond, Virginia. It includes Charleston, South Carolina. So it's some major cities, right, in those areas. And I started a network of different realtors and investors. And so now they kind of bring deals and I help with the strategy. My contribution is putting the deal together and doing the tax stuff and with a lot of partnerships that way.
Well, I know there's a lot of people wondering if they should choose their backyard market, or if they should consider doing multiple markets or virtual.
I chose multiple for different reasons, and one is my particular town changes very little. Okay, the inventory is pretty stable. Right. So there's not a lot of activity. For instance, back in 2018 in the early times when a lot of the properties kind of the market went crazy, right? Because of the crash stuff. Like our inventory prices changed very little. Our market did not drop significantly. In fact, the closest property that I own to my backyard is about an hour and a half away.
So interesting. So do you go visit every single property that you buy, or no?
Yeah.
So do you work with a lot of agent referrals, it sounds like. So do you use the agent to be your boots on the ground when you're
in a lot of situations I do, and other times I've got investors that kind of want to be the boots in the ground, the people who are learning to invest and getting their feet cut on the different types of deals. So you can always find someone like that. The important part is finding out those who will actually do the work that you ask them to do. So you got to cover yourself sometimes, like that, right? So, you want them to take pictures if they're doing stuff, and most of them will do that.
You're doing some joint venture with other
Venture type
investors.
stuff.
Okay. That's just interesting to hear and to know, for people considering doing other markets or markets within, like you said, like a 6-hour radius or something like that. So, okay.
And if you're going to want to do it yourself and do everything yourself, then of course you can't spread out that far. Right? It's just very problematic. You're just not going to be able to do it. I don't care what people say, right? A one-man show is not going to do hundreds of thousands of dollars a year in wholesale deals. Okay.
Right. Yes. No, for sure. And there's so many deals that we've done that we've literally went to the property one time or maybe 2 times, and it was like the one time was just to do a inspection walkthrough. The second time was to, but sometimes it was just one time. We put the lockbox on, and then we closed, and then we sent buyers through. We found a buyer, did everything like via DocuSign, or maybe we met up with them, and then the deal was done. And looking on those deals, it was like, well, that deal could have been done out
Anywhere.
like across the country. And so why am I limiting myself to just my local area? So I think it's a huge topic for people getting into it, because they may not have the deal flow in their local market to be able to like really get like 1 or 2 or 3 of these going a month. And so maybe they need to think about going virtual. So,
and years ago, we didn't have some of the tools that we have now, right? I mean, I've got one of my clients who has a lockbox, right, on his property, and yet he can change the code on that lockbox from anywhere as long as he's got an internet connection and uses his phone, right? When I was starting, that didn't work. We didn't have that. So that's one of the reasons that we designed and developed some of these tools and these strategies, working with leasing agents and sometimes real estate agents, mostly leasing agents. We would hire leasing agents to show our properties and stuff, and we pay them, a commission.
Sure.
Basically,
Yeah.
a percentage, right? And that's how we showed our properties from not being there. Okay?
Yeah. Absolutely. Yeah, that's great. Yeah, that's if you wanted to be a little more conservative, have somebody there to do that and not just do it yourself, like you said, with the internet connection and maybe one of those electronic.
You can still do it that way.
Yeah, for sure. So getting back to your preferred methods of acquisition, disposition, let's keep going down the line here. What you got next?
Okay, so next would be, of course, seller financing. Some people consider Subto seller financing. I do kind of, sort of, but really the seller is not putting anything into it or taking any risk, really, as far as that goes. Next would be wraps and mortgages, right? So maybe you find a seller who says, Bill, I'm not going to let you take my property subject to, right? I don't know whether you're going to pay me or not. I've got to have something in place that would protect me. And in that case, you will sign a mortgage and give the mortgage to the seller, and then you will get the deed in exchange for that. You still get the deed, but you're signing on the dotted line, right? And there are different types of mortgages. I've seen people who the seller doesn't want to do a Subto deal. He wants some type of protection. We do what's called a mirror mortgage. And a mirror mortgage is one that says you take the underlying loan and you do a mortgage yourself that mirrors or duplicates those exact terms, right? Same payment, same interest, etc. Right? But you have actually signed to the seller that you're going to make that payment to the seller. So the seller can actually come in and has the security of being able to foreclose on that property if you don't make your payments. I will sometimes give the seller a wrap mortgage that wraps around his equity and his underlying loan. So suppose we have a property, $100,000 is the underlying loan. Seller wants 150. So we give the seller a promissory note and a mortgage in the amount of $150,000, and we make the payments on that to the seller. Okay. Sometimes we will be able to take a property subject to and give a second for the equity. So let's say that same seller says, $150,000. $100,000 is the underlying loan. 50,000 is my equity. I'll just take a second mortgage on that property for the $50,000. Right? So I like that better, frankly. Okay. And people say, well, why does it make a difference? Well, the underlying loan may have a 5% interest rate. The second mortgage may have an 8% interest rate. So you're paying 8% on $50,000 and you're paying, 5% on the underlying loan. Whereas if we did a wrap of 150,000, I'd be paying 8% on the full amount. So I save some interest if I do a second mortgage instead.
Yeah, that's great. Yeah, so that hybrid model where you're leaving the loan in place and you're making payments on that subject to underlying debt, and then you're structuring a second note which the seller carries back, which has its own terms. That can be kind of anything
Separate
you
terms.
imagine.
Absolutely. And I like that because I've actually done some mortgages. The second is 0% interest.
Absolutely.
Right?
Those are the best.
So that's the nice thing about creative finance deals and seller financing. You can make the terms just about anything you want them to be within reason. There are some rules and regs that you have to follow, but they're not nearly as onerous as institutional financing rules.
Yeah, and so just to clarify too, what you're saying really with the mirror wrap is you're implementing that when a seller who has a property, which would be a good candidate for a sub-2, just gets stuck on not having the recourse to do anything if you were to default on the payment. Some sellers really get stuck on that. I think they're in the minority, but still. But you're saying that you would come in with the solution of a mirror wrap mortgage, which essentially just you're actually originating a note. You're wrapping that sub-2 debt. So it is technically a second mortgage, but it's going to just mirror the first mortgage exactly with the terms. So
exactly the same terms. And one of the reasons we actually started doing that, there were some states that considered people who took property subject to a scam. Right. And there were some bad actors out there who kind of ruined it for all of us. Right. But at one point in time in the state of North Carolina, the attorney general was actually coming in and saying, hey, you can't do sub-2 deals. They're illegal. Can't do them. Right. And he was really, the older attorney general was really down on that. And one of the ways kind of around it is you did the mirror mortgage, because then it wasn't a sub-2 deal. Well, it was classified as a sub-2 deal, but the seller was protected. Right. The seller had protection in there. And so it got around that, hey, you can't just come in and take over payments on somebody's loan and not give them protection.
So it might be a state by state thing. Do you think that so for example, I didn't know that about North Carolina. Would you always do a mirror wrap in North Carolina?
If necessarily, I'm just saying that at that particular time, the sub-2 deals were being scrutinized a lot. And then it moved away from that, right? Then the scrutiny wasn't as much. So kind of have to be careful what's going on in the market and know what the legalities are. Just like in some states you can do wholesale deals, some states you can't. Right? Remember Illinois, you're not supposed to be able to do wholesale deals. There are a lot of different states who are now coming out and saying, wholesaling is illegal. And if you want to do that, you got to have a realtor's license.
Right.
So in that case, you need to take a look and say, what is the state's definition of wholesaling?
Yes.
That type of thing.
For sure. There's usually a workaround.
Yeah. So you got to find out how you can conform, right?
Exactly.
And still do it and still do your deals legally and do them the way that you want to do them. Now, so that's a wrap mortgage. Now, close and similar to that, I consider a contract for deed almost in that same category, because a contract for deed can be treated like a wrap mortgage. Okay. If you include an owner's equity in it, it can be treated like a mirror mortgage. If you make the contract for deed the same amount as the underlying loan, it can mirror just about any of the type of structures that you want to use. And the big difference between, of course, the contract for deed and a mortgage itself is the contract for deed is just a contract to get the deed once the stipulations of the contract are fulfilled. Right. So it would essentially say that you have what we call equitable interest, equitable title to the
Yep.
property, but you do not have legal title to the property because you don't have the deed in your name yet.
Right. Yeah, and a lot of people are maybe more familiar with selling on a contract for deed, at least if they're watching like this channel, which is what I've talked about a lot. And so, but they may not be as familiar with the notion of purchasing on a contract for deed. And what you're saying is, this is down the line in terms of your preference of the acquisition
So
type,
yeah,
like you would rather do these other, but
yep,
here's contract
I
for
would do
deed. You
that.
can
I
you would
start with sub 2. If the seller doesn't want to do the sub 2, I move to a wrap mortgage and see if they'll accept that. If they don't want to accept that, for instance, they might say, Bill, I like you, but I ain't give you my deed until I get all my money, right?
right.
And
Yeah.
so I'd say, well, what if we do an agreement for deed, a contract for deed, a bond for title, an installment sale? That's all the same types of names for a contract for deed. Oh yeah, we can do that, right? No problem, because the seller
Yeah.
still has control because they have the legal title to the property. They feel more comfortable, right? That said,
So
I get all the incidents of ownership, meaning that if I'm buying a property, I'm going to use it for investment property. I now have depreciation, I have interest expense, I retain, if I'm making the repairs and maintenance, which I will be if I'm buying on a contract for deed because it's my property, I'm responsible for all that.
yeah.
Taxes, I get deductions and credit for all of those items.
I mean, the only thing you couldn't do on a contract for deed is like, or it might be more difficult to do, is go out and refinance. You could still do it, but you might have to go through a couple more hoops or something like that.
Generally, and what in my experience, you can usually go out and you can refinance, but when you're refinancing, the stipulation is the property moves into your name, right? All the underlying loans are paid off, the deed goes into your name, and then you get the financing on it in your name, right? Because most of the time, an institutional lender is not going to give you a loan on a property that is not in your name.
Right.
So we call it a refinance, but actually it's a purchase as far as the bank is concerned, because the loan, or I'm sorry, the deed, which is in the owner's name right now, moves into yours. So they consider it a purchase mortgage.
Yeah, I've heard. Yeah, I've heard so many different things when stories of people trying to go and refinance out of a contract for deed, and a lot of different scenarios. My feeling is that it might be somewhat lender dependent.
Yes.
Like if they might require you to go file the contract for deed at the county, and then that needs to sit there for 6 months or something. Things of that nature.
Seasoning, yeah,
Yeah.
seasoning and stuff like that. Yeah.
Okay.
That and it does vary from lender to lender. So
Right.
that's why if you're going to be doing a lot of institutional financing, you need to have a good relationship with a few lenders, mortgage brokers particularly. I like mortgage brokers better than just a certain lender because they're not tied to any one lender, and most of them can go out and find some type of loan structure that's going to work for your particular deal. Okay?
Right.
So
Yeah.
the big thing is that, of course, you've got the incidence of ownership. You own equitable interest in the property. You do not have legal interest in the property, right? So from a tax standpoint, you get all the deductions and stuff like that. If you are selling on a contract for deed, let's say you're an investor and you are selling on a contract for deed, it's treated as an installment sale, right? And you get to recognize the gain on the sale of that property over the life of the contract, which is really good for us as investors. Now, we talked about the difference between a dealer and an investor. If
Yeah.
you are considered a dealer, you don't get to use installment sale method for selling your property. You sell your property and you recognize that gain all in the year of the sale, whether you got all your money or not, right? So if you're not careful, you could end up, let's say that you sell the property and it has $100,000 gain on it, okay? And you're doing an installment sale and you are an investor, so it's classified as installment. You can recognize that $100,000 gain over the life of the contract. As you collect the money, you recognize the gain. If you are a dealer, that $100,000 is taxable all in the year of the sale, whether you collect that money or not. So you might have a $100,000 gain that you have to pay taxes on, and you might have gotten $10,000 on that contract so far.
You'd be negative there.
That's not fun. That's not a fun situation.
And
Because your tax on that $100,000 gain would be more than the $10,000 amount that the $10,000 amount that you received, right?
Yeah. So let me pause there, because we just said that's one of the biggest revelations maybe that some people might have when if they just go out, just start buying subject to and doing contract for deed, and they're not sitting on these properties at all. Their sole intent is just to flip them right away on contract for deed. Then and you don't hold any other investments. You're not really an investing LLC. It's not written anywhere in your operating agreement. You don't really have that intent to hold any properties. Then at that point, like, you don't realize that maybe you're more of a dealer broker, and then possibly all these sales would be, you wouldn't even be able to utilize. And let me just make this point here, and just reiterating what you're saying. You wouldn't even be able to utilize the installment sale method on your tax return. You have to be an investor to utilize installment sale method.
Absolutely.
Right. If you're
You
a
are
dealer
absolutely
broker,
correct.
yeah, if you're a dealer broker with inventory, you cannot utilize installment sale method, which is what you're saying. You can, with installment sale method, you spread out capital gains throughout the whole lifetime of that installment sale, and you don't have to pay the whole tax on the gain in the year of the sale. But if you get classified as dealer broker, then that's not the case. You got to pay.
That's not the case.
Okay.
All up front. And you have to be careful how you're getting classified. So the situation you said, suppose that you buy a lot of subject to properties, you turn right around and you sell those subject to properties right away. You don't hold the property at all. Okay. In fact, I had a client the other day, and we took a look at it. His contract to sell a property was dated 4 days before his purchase sale agreement on that property when he bought it. So he already had his buyer lined up before he ever bought the property. Right. He had the buyer already lined up, right? So he tried to use installment sale method. Ain't gonna work. Would not work. There's no way he could say he bought that property to hold when he had a contract to sell it before he even bought it, right? So you have to be careful with your documentation. So in your scenario, you buy a property, you sell it, buy a property, sell it, buy a property, sell it. You're definitely a dealer. Okay. The only way you could not be classified as a dealer is if you had someone like me, who is a very aggressive tax preparer, and you only did maybe 4 deals in that 1 year. I'd probably say you were still buying with an investment intent, especially if we could justify it with the documentation saying your LLC was set up as an investment LLC. The operating agreement said that I'm an investor to buy and hold properties, that type of documentation. And I have about 14 reasons that Internal Revenue Service gives you to sell a property without holding it, and they'll let you slide. One of those is to have money to buy more properties. One of those is to have money to repair or make renovations to existing properties. Okay. Long list of reasons that give a good reason for you to buy and sell a property right away, right? But if you did a deal a month and you didn't hold any of those, right, you probably have some difficulty convincing an auditor that you were buying properties to hold for investment, right? Okay. The more properties you might hold. Let's say that you already had a portfolio of investment properties, right? You already had some rentals, 4, 5, 6 rentals that you already had. You buy a property, you sell it. You buy another property, you sell it. Buy another property, you sell it. The fact that you're already an investor because of a portfolio gives credence to the idea that you're buying properties to hold. It's just that maybe somebody saw this property and they made an offer you couldn't refuse. Maybe you bought a property and you said, hey, I really need some more capital to improve those 6 properties I already have. They need some renovations, right? So I'm going to buy this property. I want to sell it for quick cash so that I can do renovations. right? So you've got to document and give reasons that you're an investor.
Interesting. Yeah.
When I'm working with my clients, their operating agreement specifically covers them as an investor and not as a dealer.
This transitions, I mean, this is like a really large conversation right there, and worth a lot more, like, discussion on that very topic there. Let's transition to lease and options, because this dovetails really nicely with the lease and options.
Absolutely.
So, like, why would you choose to do
A lease and option?
a
Yeah.
lease
All
and
right.
options
So
at dispositions?
on my hierarchy, right? I go through Subto, I try a contract for deed. Nah, not going to do it. Well, what if I think this property is really a great deal? I want this property, right? Something you're never supposed to do is fall in love with the deal, but my gosh, I want this particular property.
Right.
I'll say, okay, I know you're going to do it. What are you going to do if you can't sell it? What's usually the answer if you ask someone, say, well, what are you going to do if it doesn't sell?
That's it.
Usually they're going to say, I'm going to rent it, especially if it's an investment property already. I'll say, well, how about renting it to me? I'd like to come in. I'll rent it from you. I'll rent it for 3 years. I'll make sure the small maintenance deals and things like that, not capital improvements, but minor repairs and maintenance. I'll take care of all of those. I'll make sure that the payments are made on time. You don't have to worry about tenants, toilets, and trash. I'm responsible for that. And then I will cash you out at your asking price in 24 to 36 months. Is that something we should talk about? They say yes. I'm in. I will actually lease a property with the right to sublet that property, right?
Yeah.
You got to make sure that you can sublet it, because if you don't, you can't put your own tenant in there.
You're talking about doing what is called a
sandwich lease option. Yep, I will do a sandwich lease option. So people say, well, most of the time a lot of people mistakenly call it rent to owns, because it's really not. It's a rent with an option to own, right? You're not getting those rental payments applied to the purchase price, because if you do, that's a disguised sale, and Internal Revenue Service will be all over you about that. But they say, well, rent to owns really don't have a good name. Who's going to want to do that? Well, I happen to do a deal in Nashville, Tennessee that was about $1.5 million rent to own. Right. So I did a lease option on that deal. There was an attorney from out of state who was moving into Nashville, actually it's outside of Nashville in Franklin, Tennessee, which is a very nice suburb, great area. But people who are just moving into the area, they don't know whether they want to stay there permanently. So it was perfect situation. The guy, I called it an executive lease, right? Get that? Executive lease option, okay, or executive lease purchase. And he jumped all over it, because he said, hey, I'm going to be able to be in a great neighborhood. There are other attorneys, doctors, people like that who live in that particular area, extremely nice suburb. And it gave them the opportunity to decide if that's where they really wanted to stay, gave them a nice property to be living in while they made their mind up, right? And then if they wanted to buy the property, they could, because there was an option on it, and I was obligated to sell it to them, type deal, right?
Yep.
So it has its advantages. Notice that it is at the lower end of my hierarchy, right? But I'll do it.
On the acquisition side, though.
On the acquisition side, absolutely.
It's on the lowest end, so that's like the least. The last option is to do a lease and option when you're buying.
If I really want the deal, most of the time I don't get that far. I usually stick at the upper level where I'm either getting the deed or have equitable interest, because in a lease and option, I don't get the deed, nor do I have equitable interest in the property, right? It's just kind of like a situation that I find myself in. Now, the interesting part about it, if my disposition strategies are exactly opposite of my acquisition strategies, my go-to, and people don't understand why, but my go-to disposition is a lease and option. I want to sell with a lease and option type structure. And people say, why in the world would you do that? Well, I like to make sure that my buyer is going to be paying me. And if they don't pay me, I want to make sure I can get them the heck out of Dodge. right? So I'll
Yeah.
put them into a lease, and if they don't pay me at the end of that lease, when it's time for them to, excuse me, when it's time for them to exercise their option, right? I can do one of three things. If they exercise their option and they've been paying me really, really well, I will do seller finance on that deal, move right in and make more money because I'll seller finance it. If they haven't been paying me well, I say, hey, go get your own financing. And if they do get their financing, I sell the property. If they don't
Right.
get the financing, they leave, right? That type, and I still have the property. It also shows my investment intent, which I really, really love, because there is no way Internal Revenue Service is going to come back and classify a property that you have had a lease on and had it rented out to a potential buyer. Doesn't make any difference if that person actually buys it from you, right?
Yeah.
The intent was the lease, and that is an investor intent. So that will never be classified as dealer property. You have covered your butt on that.
Huge.
So it will not be a dealer property. Somebody says, well, Bill, what if they exercise their option 3 months after they move in? Well, hallelujah for them, right? Because they have that right. That option on that property allows them to exercise that option anytime during the term of their lease. Right?
Yeah.
So if they do it 3 months, they still had a lease on the property. It's still investment property. It's just that they exercise an option to purchase that property.
Let me ask a couple questions here. So you just said it's super fascinating. We've transitioned from, you've given us your preference of strategies to buy. So you've given us that. Now we're going to the disposition, your preference. And you're just saying that, first of all, it's all flipped. So whereas here it's subject to, you get the deed, and then it's like mirror wrap mortgage, if they want to do that. There's hybrid, then there's like contract for deed, then there's lease and option down here. But now for disposition, basically take that, you just flip it. We're going to start with the lease and option, then we're going to go to contract for deed.
Contract for deed.
We're going to work our way down. Let me ask a couple questions here, though. Back to, I have two questions for lease and option. Back to the buy side, I assume you try to get in with no option consideration fee?
Absolutely. Right.
Okay. All right.
Most of the time, if I have a option fee, it's $10 or less. $10 and other good and valuable consideration.
You have to have something, right? When you do an option to buy, like you have to have some valuable consideration. So you might just put 10. Is that where you're going with that?
Yep, that's where I'm going with that. And most of the time, I'm very successful with that. And the reason being, it's a residential property, right? It's usually the homeowner or maybe another investor, right? Believe it or not, investors are sometimes more difficult to deal with than just somebody who's used this as their personal residence, right? Sure. Yeah. So you do want to be careful of how you structure. What I like to do is if I have to buy, kind of using a lease and option deal, I like to get a 36-month lease, minimum 24-month lease. And then if I am selling, I have to sell, so to speak, call it selling. I have to use a lease and option deal because I can't do anything higher up than what I'm purchasing at, what I'm buying at, right? So if I am purchasing on the acquisition side, I shouldn't say purchase. If I am acquiring with a lease and option, I can't turn around, Hans, and put you in there on a contract for deed. There's no way, because I don't have that right. Okay. So remember that you can always acquire at your level or below. For instance, if I'm buying it on a contract for deed, I can put you in on a lease and option if you wanted to buy the property from me, or I could, if I wanted to. It would be legal if I wanted to do it. I could do a contract for deed with you. I could just make sure that my contract for deed or your contract for deed ran concurrent with mine or a lesser period of mine than mine.
Right. Okay. Interesting. Yeah.
If that makes sense.
It does. So yeah, no, you're saying if you buy contract for deed, you could actually sell contract for deed too.
Or lease and option, which is one step lower.
And so then that was my question. So you're trying to get in with no option consideration fee or down payment on a lease and option.
And my reason for getting in with no option fee is, dude, okay, I'm renting this property. I'm your tenant.
Right.
Why would I pay for an option, right? I'm giving you like first and last and security deposit, whatever a lease calls for. I try to negotiate just the monthly lease. That doesn't usually work, right? Usually you have to come up with like some type of security deposit or something like that. But always remember, if you're putting someone in there, that money's not out of your pocket very long. You get it back from whoever you put into the property.
Gotcha. Okay. So, but then let's go back to the disposition side now. You're talking about renting on a lease and option. So when you do that, typically what kind of a option fee for the option for the right, what
I
kind of,
don't, all right, so I don't like to see anything more than 3 to 5%. And people say, Bill, that's crazy. You do 10%. And I saw somebody one time was getting 20% as an option fee. Because when you're talking that money, you're talking down payment money. You're not talking option fee money. And my fear, okay, and I mean, in a way you say that my fear would be Internal Revenue Service comes back and declares that not to be a lease and option deal, but a disguised sale. And they try to change your lease and option from a lease and option to an actual sale of the property. And so if you're talking 10%, 15%, 20%, try to convince an Internal Revenue Service agent that's just an option fee. They're going to say, no, that's down payment money, dude. And somebody says, well, why do you care whether it's classified as a lease and option or as a disguised sale by Internal Revenue Service? Actually, it usually gets as a disguised sale by a judge before it gets to Internal Revenue Service, right? But let's talk about Internal Revenue Service first. If they change it from a true lease and option to a sale, okay, you can run into problems because you're not buying it from the seller. You don't have the right to sell the property, number one. Number two, it can change totally the tax ramifications of that particular deal. That you don't have all the tax money up front because it's a lease that these people are in there on, right? It doesn't change it for the tenant that you have in there. It just changes it for you as the person putting the deal together. Okay. Now, what I meant by a judge may have declared a disguised sale. Let's say that you have a tenant who is kind of antsy, right? At the end of the lease, they decide they don't want to get out, right? And so no, you say it's a lease, you got to get out. Then they try to sue you and get their money back. They try to get their option fee back. They try to get whatever that they paid back. And they go to court and you say, Your Honor, okay, they were in there as a tenant. This was an option fee. Here's the option agreement. It clearly states that this is a non-refundable option fee. Okay. And the judge looks at it and you charge them 20%. He's going to say, dude, who are you trying to fool? Nobody puts down 20% on a deal as an option fee. This is clearly a sale to these people, and you have to give them all their money back. Right? So those are some problems that you can run into.
We don't want that.
No, you wouldn't want that at all.
You've seen that kind of thing go down? Like
I have seen that. Yeah, I've seen that. I have seen that. Now, just like in an audit, right? Somebody says, well, can I deduct this? Can I deduct that? It's a moot point if you never get audited. Right? This is the same situation. You can charge 20% down as a lease option fee, and it's a moot point if nobody ever calls you on it.
Yeah.
Right? But if you get called on it, then you have to explain, right? I don't want to be put in that position. So I feel that 3 to 5% is a very justifiable option fee, and I will charge that to my tenant. Right? 3 to 5% on $100,000 house is still not a bad fee. Right? Somebody says, well, what if your option fee comes out to be too much and they can't afford it? I don't lower my option fee. I just allow them to make payments on it. So I'll actually give a promissory note for the balance of the option fee if they can't come up with it.
Okay. Okay.
Right?
Interesting. But and that
Some
wouldn't
people
be
don't do that. A lot of people don't do that. I will. So let's say that my tenant buyer, the option fee ends up being $10,000, and they don't have $10,000. They've got $2,500.
right.
They say, all I've got is $2,500. You know, what can we do? I'll say, sign a note for the 10 grand. Okay, 12 months. I let them go in there. Somebody says, well, why would you do that? Well, it's still a lease.
Right.
It's still a lease, right? So they're still paying me rent. They're still paying me whatever. And if they miss payments, right, they have to get evicted. I've still got a promissory note with their name on it that I can collect the rest of that on. Somebody says, well, do you really think you're going to get it? Maybe not, because if they can't pay their rent, they probably can't pay a promissory note. But if I wanted to be mean about it, I could get a judgment against them for the remaining amount on the note. Just suffice it to say that I will work with my tenants who want to be buyers.
Yeah.
But I won't
Yeah.
always decrease dollar amounts. I will just find a way that I can accommodate them.
I see. Yeah, no, I mean, that's a really interesting perspective. That's interesting. Yeah, I'm gonna add that to my arsenal, because maybe somebody is shy, maybe they would qualify for your program, except that they just are low on cash, but they seem otherwise like a good person. So you might just and like you said, you might just write a promissory note, and then they would owe you that, and then they would pay the remainder of that option fee to you over the course of X amount of months, like 12 months or 24 months.
And a lot of times I'll say, hey, look, can you just add that to the monthly payment? Right?
Yeah.
So payment would consist of part rent, part option fee.
Gotcha. Okay. So that's so interesting. So just to go back, when you're dispositioning, when you're exiting a deal, you really like the lease and option because it does make it clear that this property was bought with investment intent.
Investment property. Yep.
So then, but you might give an option. This is kind of getting to number two on your disposition preference here. You might give an option for them to buy it from you with seller financing after, is it like a set period of time? So they might transition, this lease optionee tenant might transition to contract for deed. How does that usually work out in reality? Like, is that like after 12 months or kind of whenever?
Well, generally, my tenants get a 12-month lease, period. I don't give more than a 12-month lease for my tenants.
Gotcha.
Yeah, I just give a standard lease. They usually expire or you renew them at the end of the 12 months, right? I don't give 24-month leases or anything like that, except under extraordinary circumstances. For instance, my executive lease purchase, I think, was like 18 months, right? But ordinarily, my leases run for 12 months. The option runs concurrent with the lease, which means that at the end of 12 months, they got a decision to make. They either exercise their option, they walk away, whatever, right? I've had some who renew the lease, and depending on how good of a tenant they were, if they ask me to renew their option, I'll renew their option, okay, to run with the new lease agreement, right?
Right. Right.
If they have been a good tenant and they say, yeah, I want to exercise my option, I'm going to buy the property. Say, great. How do you plan on doing that? They might say, well, I'm going to run down to the credit union and see if I can get a loan. I'll say, hey, well, what if I lend you the money? What if I finance the deal for you? And the down payment money that you were going to give to the credit union, give it to me instead. And I'll apply it to the purchase price, and then I will finance the rest, right? And I will either do a contract for deed, which I prefer, or if they want to get the deed and they're making a large enough down payment, I'll actually give them a mortgage on the property.
Gotcha. And so then at that point, getting back to the tax side of things, then at that point you have an installment sale and
Yep. I definitely have an installment sale. It was definitely investment property, and I spread the gain out over the life of the contract.
gotcha. A couple things on that point. So because we kind of skipped over when you buy on seller financing, like a lot of times you just referred to selling on like an actual wrap note, like actually originating a mortgage for your tenant so that now they become the buyer, they get the deed, and instead of doing a contract for deed where you're still the legal title, the legal owner, now they're actually the legal owner and equitable owner. Everything is theirs, and they just have a promissory note wrapping the underlying debt. They Going back to the acquisition, if you buy and sell financing, like I'll get questions if it's a absentee owner, it was a tire landlord. I get questions all the time when I'm proposing a seller financing offer about the tax implications, and I think this is helpful for folks to kind of realize that, like, if this was an investment property, then yes, like installment sale method for the seller in this case,
Mhm.
where they can actually spread out the capital gains over the lifetime of the term of that seller financing.
Mhm.
And and I just get a lot of questions from those types of people. Maybe sometimes it's like I had one recently where they depreciated the property fully. And so they were looking at a pretty large recapture of that depreciation. It was like 25 grand or something. And then they had capital gains, another 25 grand. So they were probably looking at like $50,000 or something like that, where they were going to owe that money to Internal Revenue Service in some way, shape, or form. And they were considering like my proposal for seller financing, where I could give them a lot higher purchase price, but then pay it to them over a period of time. And they were like, this is kind of attractive. So, I mean, I kind of wanted to just jump back there real quick and but then I had another question about the disposition side, but just kind of jumping back there real quick, what else would you say to a seller where you're trying to buy on seller financing, like a carryback type deal?
Yeah, if they sell to you on a contract, then they can use the installment sale method as long as they were an investor. Okay. Or if it was their personal residence, same thing is true, right? They can use, but generally, if it was their personal residence, as you alluded to earlier in our conversation, they're probably not going to have any gain anyway, because that gain is going to be less than $250,000 or $500,000 on a personal residence type situation. Rarely have I seen very many people have taxable gains on a personal residence unless they live in California. Okay. Because the properties in our neighborhood just aren't marked up that high, so to speak, unless the property is extremely old, right? Or something like that. But an investor would have capital gains implications. Now, what a lot of people don't realize is if you do an installment sale, what most investors are afraid of, and you've already talked about it, recapturing depreciation. Okay. Did you know you can spread the recapture of that depreciation out over the life of the loan as well?
The installment sale if you're buying on seller financing.
I know, and I hear even some accountants will say, "Oh, you have to recapture the depreciation," which they allude to the fact, say, "Hey, all the depreciation is taxable in the first year, right? Even on an installment sale." That's not true. Okay, that's not true. What it does mean is that your gain, like you said, hey, I've got capital gains of 25,000 and depreciation recapture of 25,000, right? Well, the let's say that the $25,000 capital gain is going to be taxed at 20%. The depreciation recapture is going to be taxed at 25%. Okay. You can still spread that entire $50,000 gain out over the life of the loan. But what recapturing depreciation means is that you have to recapture the $25,000 depreciation first. So as they're making their payments, payments normally are split between cost and gain recapture, right? If you have depreciation recapture, the first gains are split between cost and recapture. And once the recapture is all paid in to you, then they start taxing the capital gains. So essentially what happens is that over the life of that loan, you're going to have two tax rates For the first part of the loan, you're going to be recapturing the depreciation. That's going to be taxed at 25%. So some of those first payments is going to be split between the gain and the recapture, and you got 25%, right? Then once that first $25,000 is all recognized, what we call recognition over the loan, which would probably be about half of the loan period, right? Then the last half of the loan period, all the increase is going to be taxed at 20%. That's all it means. That's what it means to recapture depreciation first.
Oh, that's interesting. That's something I never heard there. So like when I'm talking to the seller who is entertaining a seller financing, seller carryback deal, then and they have depreciation and capital gains, then it's like, okay, so it's your depreciation captured first, and then once that's caught up, then it gets
then it's going to be taxed at the gain. But what is more important to most sellers is that you convey to them that they're not going to have to pay tax on that $25,000 all in 1 year, which is what they think most of the time when we talk about depreciation recapture.
Gotcha.
Right? You can say, no, you spread it out over the life of the loan. It's just taxed differently.
Okay.
Right? Taxed at a little higher rate. And they may go to their accountant and say, hey, this guy told me that I can spread the recapture out over my life of my contract. The accountant, unless he knows what he's doing, might say, oh no, you got to recapture gain first. Well, that's true, but you have recapture gain first over the life of the loan.
Okay.
So if you run into that situation, let me know, and I will send you the code, the section and the rule and reg, so that you could give it to that accountant and give him clarity.
So in other words, if we're working with you, if we're your client, and when we run into a situation like this, then we can utilize you as a resource to clarify that for a potential seller, maybe help us land that deal or something like that.
Yeah, and I've spoken with more than one seller's accountant to show him the error of his ways.
All right, that's awesome. So let me get back to I have one other question on lease and option, because this is something I'm personally interested in here. So when you're doing a lease and option, you buy a house, say subject to, and then you're like, I'm going to do a lease and option. Really, though, I'm looking for somebody who wants to own the house so that it can be as passive as I possibly can make it. However, I'm still technically the landlord, but I'm going to collect, let's say, 5% option consideration fee, like a modest fee. We'll just call it 5 for now. But I'm not guaranteeing seller financing to them. There's nothing written where I'm guaranteeing. Like, do you run into tenants? I'm sure you do. Who object to that and say, hey, this is, I'm giving you 5%. You're just telling me that you might do seller financing. Can we put this in writing that you would finance to me this property after 12 months or 24 months? Because I'd feel more comfortable putting 5% down instead of it just being a handshake type deal. Do you ever run into tenant buyers who are...
Personally, I have never, because honestly, I don't talk about offering financing until they get ready to exercise their option.
Really?
I don't even talk to if I'm putting a tenant, we call them tenant buyers. They're actually tenant optionees. Okay. I tell them they are buyers in training. Okay. Or owners in training. So when I'm explaining the deal to them, I say, hey, look, I'm putting you in here. I'm giving you the option to buy this property. I want you to treat it as if it's yours. You are a owner in training. That means that you don't call Bill in the middle of the night and tell me that your toilet's leaking. Okay. Those are types of things. You are going to treat this property as though it is yours. And then at the end of your lease, you have an option to buy this property. That's it.
Gotcha.
Okay? That's what I tell them. I don't guarantee them any financing. Now, to address your question, if you wanted to entice them, and I charge 3 to 5% for the option. It just is what it is. And they say, well, why am I paying this 3 to 5%? I said, you're paying that 3 to 5% for the right to buy this property at this dollar amount. I am promising you that if you want to buy this property, you can have this property at $175,000. Okay. And they says, Well, what difference does that make? I said, well, suppose that property goes from $175,000 to $200,000. You still get to buy this property at $175,000. That's what your option fee is for.
Right. Yeah,
Okay.
yeah.
So the option fee is the option fee. So I don't run into a problem of trying to say, I'm promising you I'm going to finance it. That's not even a mention. And the reason I don't want it to be a mention is, let's say they don't pay me like I want them to pay me, and they get ready to exercise their option. I say, great, go apply for a loan. If I had already told them that I would consider giving them financing, I've got to turn around and explain to them why I'm not going to offer it to them. And I don't want to be in that position. I don't want to say, well, you're a lousy tenant, you didn't pay on time, so I'm not going to finance this deal for you. All I've got to do is not mention it. Right. And they have to go and get their own option. So let's back up and say that you did use that to entice them. Okay. You could put a clause in the option. It would not be in the rental agreement. It would be as part of your option agreement. And it might say something like, if all payments are made with all contracts in a timely manner, or what have you, which actually refers to the lease agreement without referring to the lease agreement. Okay. Owner may offer financing at his discretion or something like that.
Like it. Yeah. So the reason I asked the question is, and this is partly my lack of experience here with doing just straight lease and options where we don't even mention, but it might be easier to find a tenant optionee, as you call it, willing to put 5% down so that you can recoup some funds back if there is a possibility of seller financing. At least I know that from my experience. Like, people like that, oh, okay, like I can actually possibly own this.
But let me ask you this.
Yeah.
Do you tell them that there is that possibility, or do they ask you if there's that possibility? Because if you don't mention it to them, in my experience, most buyers would never bring it up, because they have no idea that you're going to give them that. So I stress that the option fee is them paying for the right to purchase the property at the stated price, no increases or anything like that. Okay. I take the property off the market. They're paying for that as well, for me to hold and sit back and not sell that property to somebody else. I'm holding it for them for an entire year, right, without marketing it to anybody else. So those are the things that I stress as the reason for the option fee.
Which makes sense. I mean, I think I just suspect you might be able to move a property faster if there
That's
was
fine. If that, if you choose to do that, hey, right, at the end of the day, I tell my clients, it's your business. You run it the way you want to. If I were going to allude to that and I wanted it in writing, I would be, how do I say it politely? I'd be as vague as possible. And you don't, and you don't guarantee them the right to financing, right? Because you don't want them to think that hey, you're promising them that you're going to finance it for them. So you want to move away from that. So if I were going to put it into an option agreement, I would say something like, at the end of the agreement or upon exercise of this option, if optionee has made timely payments on all existing contracts, did maintenance to the property as agreed, or kept the property up as agreed, owner may consider financing the purchase price, something like that.
It's a nice vague statement there, where at least you're putting that idea out there. I might suggest considering like if you want to use an RMLO or have somebody who to like properly underwrite these people, if you're going to do like a note, like wrap it, that you could just also make it contingent on their ability to qualify with some, like a professional underwriter. Because then at that point, because if they're being late on their rent payments, like, you're the landlord, the RMLO is going to ask you if they've been late on any of their rental payments or if they've been on time. And if they've been late payers, then they're not going to qualify. So it's not up to
Right.
you. It's up to some third party professional underwriter. And
Correct.
then,
But that's a very good point. And I would just say that's probably something I haven't considered. And the reason I haven't is when I first started doing this, they didn't have RMLOs, so we didn't have to worry. We didn't have to worry about that.
for sure,
Right.
yeah, pre Dodd-Frank, all that stuff, yeah.
And remember too, the only reason I would get an RMLO on this particular type of deal is if you ever wanted to consider selling the note. Okay, because if you're not selling the note on this particular type of deal, an RMLO would not be required.
Is that the case if, unless you're saying selling on a contract for deed in particular?
Even if you sold with a mortgage, because don't forget that under Dodd-Frank, okay, every owner has one sale per year that is completely excluded from Dodd-Frank rules and regs, right?
Yeah.
All right? And who is selling this property? Not you. The trust that is holding this property would be the seller.
Gotcha.
So the trust that is holding this property, it would only be one sale.
Right.
And then the trust is over with, right? But every trust would only be doing one sale. So if you structure your deal correctly, you would never run into Dodd-Frank.
That's interesting
because your sale is excluded under Dodd-Frank.
I gotcha. Yeah. So yeah, that's how you might get
a reason to use trusts.
Gotcha. Okay. Yeah, no, that's interesting. So you might utilize the trust vehicle to get around the I thought it was more than 3 in a rolling calendar year, but maybe it's just 1. I don't know exactly.
No. Yeah. 3 in a rolling calendar year means that you have to meet some of the Dodd-Frank rules and regs, but you don't rise to the level of having to have a mortgage loan originator. That's where the 3 comes in, which means that you can do your own deals. You can underwrite your own deals, but you may not be able to use a balloon payment. You may not be able to do negative amortization. You can't go over a certain number of years. You still have to meet those Dodd-Frank rules and regs. Okay. Yeah. The one deal exclusion means that nothing in Dodd-Frank applies to you. If you want to use a balloon payment, you can. If you want to amortize over 15 years, you can. You want to amortize over 40 years, you can, because Dodd-Frank does not apply.
And that's interesting. Yeah. This is a whole nother can of worms right here.
Yeah. And that's the thing. Originally, when Dodd-Frank was written, I did a very thorough study of Dodd-Frank rules and regs. And a lot of people are trying to say Dodd-Frank rules and regs applied to lease and option deals. It does not, because a lease and option is not a sale. Okay, you're not selling the property with the lease and option. Okay, it does apply if your tenant optionee exercises the option and you do a mortgage note. Okay, then that's when Dodd-Frank may kick in. But under these circumstances, if you do it like I tell you to structure the deal, the rules and regs will not apply.
Because it's every individual deal you buy is held in its own individual unique trust. And
you're not the owner of the property. You're not the seller of the property. The trust is the seller of the property.
Okay. Gotcha. And you think that would fly in the face of scrutiny? Like if they're like, well,
let's put it this way. It conforms to the exact statement of the law. Now, if they want to change the interpretation of it, then you might have to have a judge decide. But I am thoroughly convinced that it meets the letter of the law.
Gotcha.
Because before I ever started, because it says specifically in the Dodd-Frank exclusion, it says that an individual or a trust is included, can sell a property with that one-time exclusion. And what someone tried to convince me of and say was that, oh, well, what if you're the beneficiary and you've got one beneficiary for 15 different trusts? Do you mean that they can sell all those properties? That's 15 different properties. I said, absolutely. But the beneficiary does not own the property. He's only entitled to the rents and prevails, the money from the property. That's it. That's all he gets. He doesn't have any ownership of that trust.
Dodd-Frank actually says that. It actually mentions trust explicitly.
Mentions it in there. And here's the thing, it's open to interpretation. And before I can't definitively say it will apply in every situation. Here's why. It's never been challenged. You would have to have a court decision, like a lot of other things, before you would find out how it could legally be interpreted. But I'd treat this like I would an audit, right? If I can defend it, I'm going to. And then if they change it, you just have to adapt and punt, whatever.
Yeah, and just to clarify, I'm not an attorney, and you're not an attorney.
I am not giving legal advice. Thank you for bringing that up. Okay. Someone would drop a safe on my head if we didn't make that exclusion. This information, okay, is for educational purposes only.
Right.
And if you have and I should have said this at the beginning, if you have a question particular to your specific tax situation, then by all means, you need to check it out with your tax pro. You need to run this by your tax person, because I have no idea what your tax situation is, because you're not my client, right? So this is for general information, but I stand by my education.
No, that's great. That's great. I think that kind of brings us full circle. We're at about an hour and a half. This has been an awesome conversation. You gave us like your 5 preferred acquisition strategies, flipped them on the disposition strategies, and we discussed all these interesting tax implications as well for each and every one. I know I like to talk taxes a little bit. I'm a little bit outside the norm there, but whether you like to talk taxes or not, you got to know. you need to
know some of this stuff. Yeah,
you need an expert who's going to help you navigate the tax implications, because, like you said, every deal has legal implications, but then we often neglect the tax implications. So I just want to thank you, Bill. I think we'll wrap it up here. This was a very informative conversation. I enjoyed it very much. Thanks for being here with us today.
Happy to be here.
And if anybody wants to get a hold of you, what's a good way for people to reach out to you?
They can usually find me on Facebook, right? I take messages, so they can message me on Facebook. If they want to shoot me an email, it is bill@billwalston, WALSTON.com.
Awesome. All right. Sounds great. Thanks again, Bill. And we'll see you on the next one. All right.
Thanks, buddy.
All right. Later.